Okay, so with the previous class, we looked at the expectation gaps, and we define expectation gaps as gaps that exist between what auditing is and what other people think auditing should be. So that gap is what we refer to as an expectation gap. For example, one of the expectation gap is that some people think that the auditor does 100% check, and we've all agreed now that the auditor doesn't do 100% check. The auditor does what we call what? Sampling. He doesn't check all the items in the population. He does what we call what? Sampling. And we looked at another expectation gap that says that when the auditor issued an unmodified audit opinion, it means that he has guaranteed or he has certified the financial statement. And we've all agreed that that is not accurate. The auditor doesn't certify the financial statement. He gives an opinion on the financial statement. So that becomes another expectation gap. So today we'll be looking at the other classification of auditing, and then we'll be looking at inherent limitation of auditing. And then if time permits, we'll start with our very first auditing standard, ISA 200. So by 8:30, 8:45, we are done. Okay, so looking at other classification of audits, we have financial statement audits, compliance audits, operational audits, and forensic audits. So let's look at them one at a time. So when we talk about financial statement audit, we are saying that it is a form of audit where the auditor basically examines the financial statement in its detail. So remember, when we talk about financial statement here, we are talking about what? The full component of the financial statement, which consists of the income statement, the statement of financial position, the statement of changes in equity, the cash flows, and then the notes to the account. That's the full components of the financial statement. So when the auditor examines these various statements, it is termed as what? A financial statement audit. A financial statement audit. Any questions so far? Any question from Rocky, Daniel, Suleiman, and someone is using, there's no name, please. The person who is using is it a globe? Can you change it to your name, please? Please change it to your name so that we can all follow. Is that okay? Okay. So then we look at compliance audits. As the name states, so a compliance audit is basically an audit carried out where the auditor is trying to like examine whether the entity has complied with its internal rules, policies, and procedures. So, for example, an entity may have its procedures in terms of how it's supposed to record certain transactions and all of that. And based on those procedures, an entity can carry out a compliance audit to check and see whether the entity in itself has been complying with these provisions. that it has in its own procedures. So that is termed as what? A compliance audit. That is termed as a compliance audit. So a compliance audit is an audit that is carried out to determine how the entity has complied with its own rules, policies, and procedure. Or sometimes a compliance audit can be carried out by a government institution to see whether the institutions that it supervise, whether they've been compliant with its procedures and processes. So let's take, for example, Ghana Standards Authority. They set standards on how industry should be and all of that. So sometimes they can carry out a compliance audit to just cross-check and see whether entities have actually complied with the stated procedures and whether they've complied with what they are supposed to do. So that takes the form of what? A compliance audit. So we have, for example, GRA is the examination of tax returns of individual and companies by the Internal Revenue Service. Now we call it GRA for compliance with the tax law. So GRA can carry out a compliance audit to see whether the entity has actually complied with provisions in the tax law. So it is termed as what? A compliance audit. It is termed as a compliance audit. Then let's look at an operational audit. An operational audit is similar to a compliance audit, but they also differ in the sense that with an operational audit, the entity is seeking to abreast itself with its operations and see whether it can be more efficient, it can be more productive, and whether it can save resources and all of that. So normally we carry out an operational audit to check the performance of the entity to see whether there are areas in which they can improve, and recommendation from these operational audits are normally used to what? To improve on the entity performance. So operational audits, they are very, very important. Even in your life, you should be carrying out an operational audit to just cross-check and see whatever you are doing, whether you are achieving your goals. And if you are not achieving your goals, the steps you will take to what? Correct them. That's what we mean by what? An operational audit. So in the sense of an entity, the entity will carry out an operational audit in order for them to assess their performance in terms of their operations. Yeah, we are not talking about financial performance. So let's say an entity is a manufacturing company. They manufacture cement. They can carry out an operational audit to see how their processes look like and whether they can get better way of doing things so that they can be more efficient, effective, and productive. So that kind of audit is called what? An operational audit. An operational audit. So we say the objective of the management audit, it includes different objectives, but most of the time, these management audits are normally requested by management. So they are for management consumption. So sometimes we say they are for what? Internal consumption. So what normally happens is that if the entity has a very strong internal audit department, most of these other forms of audit can be carried out by the internal audit department, like the operational audits, the compliance audit, and all of those. It can be carried out by the internal audit department. Sometimes, because of independence and all of that, the entity may want to like request for an outside person to carry out this audit for them. So these are some of the areas in which management audits covers or it includes. So what about forensic audits? What do you know about forensic audits? Anyone, please? What's your understanding of forensic audits? What's your understanding of forensic audits? So when we talk about a forensic audit, it is a form of audit that involves a detailed examination and assessment of a firm's financial records. So sometimes it's not everything that the audit can unearth. Remember, the primary objective of the auditor is not to detect, prevent fraud and those things. That's not his objective. However, in the form of a forensic audit, it means something has actually gone wrong or there's a suspicion of wrongdoing. Therefore, the auditor in this case will be needed to what? Go beyond just the regular auditing. So in the forensic audit, the entity will be actually looking for means to detect fraud because there's a suspicion of fraud. So in this case, the auditor will be checking for these things and how to unearth or how to detect any of these fraudulent activities. So normally forensic audit is carried out where there's a suspicion of fraud or actual fraud has been committed. So these are some of the areas in which forensic audits can be carried out. Business or employee fraud. So if there's a suspicion that a particular employee has committed fraud, in that case, the entity will appoint a forensic auditor to come and audit the activities of the entity or that employee to detect and see whether actual fraud has been committed. And normally, the result from what you should know is that the findings from the forensic audit or the evidence from the forensic audit, they are normally used in legal proceedings. They are normally used in legal proceedings. So I don't know, some of those of you who listen to current events and all of that, just last week, the AG, during one of his press conferences, he made a statement that they are going to carry out some number of forensic audits on some suspected fraud or actual fraud that has been committed. So the essence of this forensic audit is that when he gets the evidence from this forensic audit, he can use it in his legal what? Proceedings. So normally findings from forensic audits are used for what? Legal proceedings. So here the auditor is actually checking for errors and fraud. He's detecting them. He's doing his best to what? Detect those things. Then sometimes we carry out forensic audits in criminal investigation. So if there's a suspicion of crime that has been committed, a forensic audit will be needed to unearth what has been done or to establish guilt or not. And then also in case of business economic losses, matrimonial disputes and all of that, a forensic audit will be needed in order to what? Settle the dispute and all of that. Okay, please, any questions so far on the different classification of audits? And please, by the way, why is it that a lot of you have joined the class so late today? Is there a reason? Because we've already done 20 minutes of the class. Okay, so let's now look at the inherent limitation of an audit. So when we say inherent limitation, what we are basically saying is that there are certain things that no matter what you do, you cannot do much about it. These things, they exist in an audit. Can someone give me an example? So the inherent limitations are limitations that the auditor cannot do anything about it. These limitations, they are there, they exist. So that's why we say the auditor carries out the audit in a way to gather what audit evidence. But at the end of the day, the auditor doesn't give an absolute assurance. He gives what we call what? A high level assurance. He doesn't give an absolute assurance because he doesn't audit everything, so he cannot give you an absolute assurance. However, it's not because there are inherent limitation in audit. That doesn't give room for the auditor to be lazy or for the auditor not to be what? Professional in the purpose of conducting his audit. Despite this inherent limitation, the auditor still owes a duty to be very thorough in whatever he or she does. So let's look at some of the inherent limitation of an audit. So we say one, the nature of financial reporting. We all know that financial reporting in itself is based on lots of estimates. So for example, depreciation, provision for bad debts, provisions, accruals, these are all estimates most often. And once they are estimates, it means before someone can give an estimate, it means the person is giving what? A judgment. And these judgments, sometimes, because of the nature of them, they may not reflect the reality. So because of these estimates and judgments that management may take, for example, in selecting their accounting policies, management can decide that we are using FIFO. Another management can decide that we are using weighted average just to measure inventory. Management can decide that we are using straight line method. They can also decide that we are using reducing balance. And you know, each of these methods, if you decide to use each of these methods or estimates, your financial results is likely to be what? Different from each other. So because of these estimates and judgment that involves in financial reporting, there's a likelihood for the financial statement in a way when prepared by the accountant, it limits the auditor in a way, because what so much can the auditor do if the entity decided to use straight line method in terms of its depreciation? There isn't much the auditor can do because the auditor doesn't select the accounting policy and estimate. These things are done by management. Management uses their judgment to select these things. So because of that, it caused what we call what? An inherent limitation in audits. And then also, is a built-in restriction. Also, the nature of audit procedure. Remember, I told you that the auditor doesn't audit everything. He does what we call what? Sampling. So sampling simply means where the auditor perform audit procedures to less than 100% of the items. So maybe out of 100 items, the auditor may select only 15. And based on that 15, he's going to gather evidence on that 15 and then draw a conclusion. So based on that, he cannot audit everything. Therefore, he is limited. He's limited. The procedure he used has limited him not to audit everything. So because of that, it forms part of what? An inherent limitation. And also the timing of the audit. Remember, the timing and the cost is also an inherent limitation. That is to say, the auditor must be able to carry out the audits in a reasonable period of time. You cannot be auditing the client throughout the year. It doesn't work like that. So therefore, the audit must be carried out in a reasonable time. So because of that, since the auditor doesn't have all the time in the world to audit the client, it means he cannot audit everything. He's restricted by what? Time. And then the cost. If the auditor decides that, okay, do you know why? I'm going to audit you for the whole year. The cost that will be involved will not be for joke. Just when they come and audit for like a month, sometimes 3 weeks, 5 weeks, some of them they take as high as $35,000, $45,000. You can just imagine if the auditor was supposed to come and audit for the full 12 months, just multiply $25,000 by 12 months and just see how much you're arriving at. How many entities will be able to afford that? You are talking about close to $300,000. Most entities will not be able to afford that. It will make the audit in itself to be even more expensive. Therefore, that forms part of what? A limitation. That forms part of what? A limitation. Okay. Then let's look at another inherent limitation. Fraud. So sometimes, remember, we said the auditor's aim is not to go and unearth or to detect fraud and those things. That's not his major aim. Even though in the process of auditing, if he come across fraud, he will use audit procedures to deal with those issues related to fraud. However, some of the fraud cannot be detected because if the fraud has been committed by, let's say, a senior management, let's say the CEO or the CFO, they will do everything possible to what? Hide it. So those issues that they know that they've committed fraud in themselves, they will not even want to what? Release those documentation for the auditor to audit. So in that instance, what can the auditor do? He cannot do much. So that specific fraud will go undetected because those involved in that activities were top management. It was top management. So it will be difficult to what? Unearth those kind of fraud. And then the existence and completeness of related party. There's a topic in auditing called related party. There's a whole standard on it. I think ISA 530, something like that. Related party, these are people that have close connections with management. So let's say the CEO wife, the CEO children, the CEO brothers and sisters, companies that the CEO owns, some of the companies that he sits as a director, these are all related parties. And the reason why related parties are very important in auditing is that most often transactions that involve related parties are not carried out at an arm's length way. That is to say, they are carried out at a more favorable means. So let's say, for example, if the CEO owns another company and he has asked that company to come and do a piece of work for this company that he's a CEO of, do you think that the amount he will quote will be a reasonable amount? No. It may even be an amount that is slightly higher than any other if it was taken by what? An independent person. So because of that, because of these related parties and transactions and relation, and sometimes management don't even disclose the related parties. So if they don't disclose it, how does the auditor expect to know? The auditor is not an angel. He cannot know everything. And then non-compliance with laws and regulations. So all of these are what? Inherent limitation. And then another very important inherent limitation is internal control limitations. If the internal controls of the entities are so weak that they cannot safeguard the assets and resources of the entity, people are doing all kinds of things that they want. It simply means the auditor may find it very difficult to what? Audit, because it means processes are not in place. People can do things and they'll be able to find their way around. And since the auditor is not there to audit everything, he may find it extremely difficult to what? Unearth some of these things. So when the internal controls are weak, or even though there may be internal controls, if the internal controls are deficient or if they are limited, it leads to what? An inherent limitation in the audit exercise. The nature of audit evidence. You see, the audit evidence are evidence that the auditor gathers in the process of what? Auditing. If these evidence are not conclusive in a way, it becomes difficult for this evidence to just be relied on. That's why we say most of the time the audit evidence, they are persuasive. That is to say, they just give a probable cause. Okay, most of them are not conclusive in nature. So this can lead to what? A limitation in the audit exercise. And then availability of audit evidence. This is very, very important. Wherein sometimes management deliberately will hide evidence from the auditor. Maybe the auditor has sampled a specific number of invoices that he needs to what? Verify. Management has those invoices, but they know that if they give out those invoices, the auditor will be able to what? Detect some issues with it. So what do? They will hide it. They will not make those invoices available. So when they do such things like that, it means the auditor will be limited. He cannot go and fetch out results or evidence that he doesn't have, that management is supposed to give him, but management is refusing to what? Give it to him. So it becomes what? A problem. And even the audit opinion by they themselves, the auditor just express an opinion. He doesn't certify the financial statement. So this becomes what? A limitation. An opinion is an opinion. He doesn't say the financial statement has been certified. That is to say, it is free from all errors and misstatement. So because of that, the auditor is also what? Limited. Okay. Please, just a second. So because of the audit's opinion, the audit's report in itself is an opinion kind of report where the auditor express an opinion. He doesn't certify it. It means the audit in itself is what? Limited, because it's just an opinion he's given. He cannot certify all of these things. So we are saying that because of this limitation in the audit work in itself, there's an unavoidable risk. Unavoidable, please take notes. There's an unavoidable risk that some material misstatements of the financial statement may not be detected, even though the audit is properly planned and performed in accordance with the international standards on auditing. We are basically saying that even though the auditor may follow all the audit procedures, all the auditing standards, but because of the nature of these audit limitation, this inherent limitation, there could be some material misstatements that he may not detect. It is very possible. So we say, accordingly, the subsequent discovery of a material misstatement of the financial statement resulting from fraud or error does not by itself indicate a failure to conduct an audit in accordance with ISA. So we are saying that if after the audit and there has been an evidence that a material misstatement existed or there was fraud that the auditor was not able to what? Detect. That fraud or misstatement doesn't negate that the audit wasn't done in accordance with the ISA, because the inherent limitation will stay what? Limit the auditor. It will stay limit the auditor. So we say, however, the inherent limitation of an audit are not a justification for the auditor to be satisfied with less than persuasive audit evidence. Good. I love this point. This point is trying to tell us that even though there are inherent limitation as an auditor, it doesn't mean that you should be lazy and say, because there are inherent limitations, so mean there isn't much I can do in order for, no, you should still be able to apply your audit procedures, your audit processes, and your audit rules in a way that at the end of the day, the opinion you'll be giving, those opinion will be based on what? An audit evidence that has been thoroughly what? Cross-check. Okay, please, any question at this point? We've looked at other classification of audits. We explained them to be what? Financial statement audits, forensic audits, compliance audits, and operational audits. And we just looked at inherent limitation of an audit. So right now, let me introduce you to another topic, which we'll not be able to finish today, but at least to just get an idea about it. So this is our very first standard in auditing, our very first standard. And the standard is called what? What's the name of the standard? Please, this thing, it always comes in the exam, so let me color it. You always be asked, what is the objective of ISA 200? So our first standard is ISA 200, International Standards on Auditing 200. International Standards on Auditing 200. So this standard explains that the objective of the auditor is that he or she carries out the audit in accordance with the international standards on auditing, therefore meets internationally accepted best professional practice. So every audit that the auditor conducts must be in compliance with the international standards on auditing. So he has a blueprint that he must follow. It's not like he's following his own things. No, there's a blueprint, and that blueprint is what? The international standards on auditing. And we continue that whilst working within this objective, the auditor must also have regard to the need for each audit to be carried out in the most cost-effective manner. We are saying that it's not because the auditor must follow the standards thoroughly. He must also be mindful that there's a cost implication to whatever he's doing. So therefore, he must do a cost-benefit analysis. So there must be value for money in whatever he's doing. There could be certain evidence that he might need to gather by using some very expensive means to gather that evidence. If he can use a cheaper means to get the same evidence, then it is better he use what? The cheaper means. That's why we say what? The most cost-effective manner. So we say in summary, ISA 200 requires the auditor to comply with all ISAs relevant to audits. He is also supposed to comply with the ethical requirements. That's our next topic. Fundamental ethical requirements of an accountant. There are actually 5 in nature. So the auditor is supposed to comply with these ethical requirements. He must also plan and perform his audit with professional skepticism. What is professional skepticism? Anyone? My friend Peter, what is professional skepticism? Anyone, please? Okay. Professional skepticism simply means the auditor has a questioning mind. He wants to know everything. He wants to understand everything that is happening. That's what we mean by what? Professional skepticism. He's not too confident with whatever management is giving. He wants to always cross-check. That's why sometimes they say auditors are very inquisitive. Yes, as an auditor, you have to be very inquisitive. If you are not, then you cannot be an auditor. Then you don't have that skills to be an auditor. Then professional judgment. He must exercise professional judgment in planning the audit. It's not everything that he come across in the audit should be a big deal. Some of the things, they are immaterial issues. Some of them, they are just small issues. These small issues, there's no need to make big deal out of them. So the auditor must be mindful of these things also. And then he's supposed to obtain sufficient and appropriate audit evidence to allow him to obtain reasonable assurance. This is very, very important in auditing, and I'll be talking about it quite a lot. The evidence the auditor is going to gather, that evidence must be what? Sufficient. That is in terms of what? Quantity. And then it must also be appropriate. That is in terms of what? Quality. So sufficiency deals with what? Quantity. And appropriateness deals with what? Quality. So the audit evidence must both pass that test of quality and quantity. It must be both. So this is the objective of ISC 200. The auditor should obtain reasonable assurance to report on the financial statement and communicate as required by the standards in accordance with the auditor's findings. So he reports on the financial statement based on his findings. That's the audit evidence he was able to gather. Please, any question at this point? Hello, any question, please? Please, is there any question? Please, is there any question?
No.
Okay, great. So I'm bringing the class to an end here. We'll meet again this week, but that one will be a bit more lengthy, so that will cover at least an additional 1 hour. We are almost done with, when we are done with this unit, we would have done like 45% of the total lecture notes. So please, the recordings are there. Please go and watch the previous ones plus this one. I'm sure this one will be uploaded before I'm sure maybe by 12 o'clock.
All right.
Okay, friends, thank you very much. It was nice having you. And have a
Thank you
good
too.
one.
Yeah.
Okay, bye.
Bye.